Let's review historic market crashes to understand them better before discussing the current state of the market. The 1929 crash, the Great Depression. The Dow plunged about 89% from peak to bottom. Causes included over-leveraged buying, margin debt, speculative bubble, and lack of regulation. The recovery took until the mid-1950s, the government response, creation of the SEC, tighter banking regulations, Glass-Steagall Act. The 1987 crash, Black Monday. The Dow fell 22% in a single day. Causes included computerized trading, program trading, and portfolio insurance failure. The recovery was quick. It happened in about 2 years. The government response, the introduction of trading halts, circuit breakers, the 2000 crash, the dot-com bubble. The Nasdaq lost about 78%. The S&P 500 declined about 50%. Causes included tech stock overvaluation and excessive speculation. The recovery took around 7 years. The government response, regulation tightened around accounting practices, the Sarbanes-Oxley Act. The 2008 crash. The Great Financial Crisis, sometimes described as the Great Credit Crisis. The S&P 500 fell about 57% and credit imploded. The causes included a subprime mortgage crisis, CDOs, overleverage, banking system collapse. The recovery took about 6 years, faster for equity than credit. The government response, TARP bailouts, the Dodd-Frank Act, aggressive Fed intervention, QE or quantitative easing, the 2020 crash, COVID-19. Pandemic, the S&P 500 dropped 34% in 1 month. The causes included global pandemic fear and economic shutdowns. The recovery was extremely fast. It happened within 6 months. The government response was massive stimulus, the Fed slashed rates to near zero, and unprecedented liquidity. Signs of market euphoria. Trading volumes are going higher. Volatility is increasing. It is normal to have 1% daily moves in the major indices at the moment. FOMO, the fear of missing out, still seems to be prevalent in the market. People saying this time is different. Have we heard that before? The Buffett Indicator, market cap versus GDP, currently high, signaling overvaluation. Speculative behavior, meme stocks, crypto surges, although off of their highs. Margin buying and debt among people and investors is higher volatility. Patterns, spikes in the VIX often precedes corrections. Technical indicators. The S&P 500 trading far above its 200-day moving average. The RSI, Relative Strength Index, showing overbought conditions for some segments of the market. Fibonacci retracement levels signaling possible reversal zones. How to position your portfolio. Increase allocation to bonds and commodities. Gold, silver, energy. Within stocks, tilt toward dividend-paying value stocks. Consider dollar-cost averaging to buy during dips. Maintain cash reserves, dry powder, to capitalize on market disruptions. Study strategies of smart investors like Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. A closing summary. History shows that crashes are inevitable, but recoveries happen. Emotional discipline, smart positioning, and preparation matter more than timing the market. Final tip: stay diversified, stay calm, and stay informed. If you like this content, please like, subscribe, and comment. Thanks for watching Market Atlas.